When we think of investing, we picture stock tickers, Wall Street suits, maybe even Bitcoin charts. But if you zoom out way back, investing's story starts not in cubicles and conference rooms, but in fields. Picture this. It's 4,000 years ago. You're toiling in a Mesopotamian field. Life's tough, unpredictable, and the next season's harvest hangs in the balance. Suddenly, a stranger approaches, holding out seeds. "Here," he says, "plant these, and after harvest, give me back the seeds, plus a little extra." Voila, you've just made your first investment. Crazy idea, right? But actually, that seed swap was the OG investment, the world's first financial transaction. But hold on, where's the profit? Well, in agriculture, the profit is securing a future harvest. You trade a small amount now for a larger stake later, and in that exchange lies the essence of investing. It's about delayed gratification, betting that tomorrow's bounty will outweigh today's efforts. That basic mindset is still the bedrock of investing today. Whether you're plowing fields or pouring money into stocks, you're essentially doing the same thing, sacrificing a bit now for a potentially bigger payoff later. This instinct isn't just economic, it's hardwired into our DNA. We don't naturally love delay and sacrifice. We'd rather have immediate pleasure. But we know that if we plant the seeds today, we'll have food to sustain us until the next harvest. And that's why we have this drive to secure our future. As humanity progressed, so did the stakes. In ancient Babylon, merchants extended credit to farmers, lending grain during planting season with the expectation of repayment plus interest after harvest. This wasn't altruism, it was early-stage venture capital. They believed that helping farmers now would ensure they had a steady supply of goods later. In ancient Greece, wealthy citizens would lend money to rulers and generals for military campaigns, hoping for a return on their investment. Each of these deals, from the seed exchange to the merchant loans, were based on a simple premise. Today's sacrifice could lead to a greater gain tomorrow. It was a calculated risk based on trust, prediction, and the belief in a prosperous future. Fast forward to ancient Rome, where investing took a giant leap. Now, the Romans weren't known for their individual investments, but for grand public projects. But how were these projects funded? Enter the concept of pooling resources, a core aspect of investing that's still prevalent today. Rich Romans would club together with other investors to send ships on trading voyages. These expeditions were risky. Some ships would come back laden with treasures from the east, while others would sink without a trace. But those who pooled their money for the ventures shared in the profits if the voyage was successful. Similarly, individuals who opted out of these ventures missed out on potential riches. This wasn't just about making money. It was also about the allure of discovery, the thrill of exploring uncharted territories, and the lure of exotic goods. It tapped into the deep-rooted human desire for exploration and the promise of untapped markets. It was a form of venture capital in the days before Silicon Valley. Back then, the investors were funding explorers, not app developers, but the psychology was the same. There was a shared risk, a collective hope for success, and the promise of significant returns. By the Middle Ages, banking houses were already an established feature in European economies. They were the go-to institutions for managing finances, including investments. These houses would pool money from wealthy merchants and noble families, providing them with loans for various endeavors, from expanding trade networks to funding artistic projects. The rise of banking houses signifies a pivotal moment in investing's history. It marked the transition from individual investors to a more formalized system, where specialized institutions managed and facilitated the flow of money. But the driving force behind these investments remained the same: the innate human desire for growth and prosperity. During the Renaissance, trade routes expanded, bringing in new goods and creating fresh opportunities for investment. Investors began looking beyond traditional ventures into areas like art and exploration, recognizing potential returns in unexpected places. In the 1600s, the world witnessed the birth of a revolutionary concept, the stock market. The Dutch East India Company, established in 1602, pioneered the sale of shares in a company. These shares represented a fraction of ownership and entitled the buyers to a portion of the company as profits. This groundbreaking concept allowed everyday people to invest in global trade and reap its rewards. The company thrived, becoming the world's first publicly traded corporation and setting the stage for modern capitalism. By the mid-17th century, Amsterdam had become a prominent hub for international trade due to the Dutch East India Company's success, leading to economic prosperity for the city and its residents. This marked a significant shift in the role of investing in society. It wasn't just about funding expeditions or ventures anymore. It was about owning a piece of the action, participating in the growth and prosperity of a company, and sharing in its successes. But with great opportunities come great risks. Enter Tulip Mania, a bizarre episode in the 1630s where the price of tulips skyrocketed in Holland. People were trading tulip bulbs for exorbitant amounts of money, with one bulb fetching as much as 10 times the cost of a house. It was the first recorded asset bubble in history. As the mania peaked, more and more people rushed to invest in tulips, believing that the prices could go even higher. But inevitably, the bubble burst and the price of tulips plummeted, leaving many investors in financial ruin. It was a stark reminder of the unpredictable nature of investing and the pitfalls of unchecked speculation. This period also revealed another aspect of human nature, our susceptibility to herd mentality. When everyone around seems to be making money, it's easy to get swept up in the excitement and lose rational judgment. The tulip bubble showcased both the potential rewards and the perils of investing in a world driven by speculation and hype. Fast forward to the 1700s and 1800s, and we see investing evolving into more formalized systems. The London Stock Exchange, established in 1773, and the New York Stock Exchange, founded in 1792, provided regulated marketplaces for buying and selling shares. These exchanges brought more legitimacy to investing, offering investors a platform where they could trade their shares with relative ease and security. During this time, investing was primarily associated with wealthier individuals and institutions. The common folk didn't usually have access to investment opportunities. In the early 20th century, investing underwent a seismic shift. The introduction of mutual funds allowed individuals to pool their resources and invest in a diversified portfolio of securities. This innovation opened the door for ordinary people to participate in the stock market without having to manage their own investment portfolios. Another groundbreaking development was the advent of retirement accounts. These accounts provided a vehicle for individuals to save and invest a portion of their income for their later years. The most famous example is the American 401k, which was introduced in 1978. These retirement accounts offered tax advantages, encouraging people to invest regularly for their future. Furthermore, the concept of an index fund, pioneered by Jack Bogle in 1975, provided investors with a low-cost way to mirror the performance of a particular market index. Index funds have become a cornerstone of many investment portfolios due to their diversification and low fees. These innovations democratized investing, making it more accessible to the masses. Retirement accounts gave people a reason to save, while index funds offered a simple, effective way to invest. Today, we live in a world where anyone with an internet connection and a smartphone can invest in a variety of assets from anywhere in the world. Online brokerages have broken down geographical barriers, allowing investors to tap into global markets with a few taps on their screens. But this accessibility has its own set of challenges. With the proliferation of investment apps and platforms, there's an overwhelming amount of information and opportunities available to investors. It can be difficult to navigate this complex landscape and make informed decisions. Moreover, the anonymity of online trading can lead to herd behavior, where investors follow the crowd without fully understanding the underlying assets or the risks involved. The ease of buying and selling can also contribute to impulsive decisions driven by emotions rather than logic. Now, the question is, what does the future of investing hold? Will technology continue to disrupt the industry? Will new investment avenues emerge? And how can investors adapt to keep thriving in this ever-changing landscape? Only time will tell. So, how did investing start? With seeds and trust, bartering for a better harvest, and sharing the risks and rewards of the unknown. And how is it going? With screens and hype, chasing digital gains and riding the latest trends. But deep down, it's always been about the same thing: the belief that tomorrow can be bigger than today. If you liked this episode, check out this playlist, a journey through the entire history of money. See you there.